And are we gonna, like this one's kind of important from an internal standpoint. Does it fail to meet the firm standard from an economic standpoint? In other words, do we think we're gonna make money on it? I mean, if it's something where, they want us to quote an amount and we're like, there's no way we could ever do it for that. We're probably not gonna do it. We're probably gonna accept that engagement. Anything else that's uncomfortable about the client, So ultimately we come down to yes, we should, or no, we shouldn't accept. So select accept. And then if it was a new client or an initial audit, there's some additional questions, again, kind of the same thing though. Did they refuse to authorize this or that? Did they refuse to accept responsibility? So we ran through this. Okay, we decide yes, we're gonna accept this client. We're gonna do the audit. So now we get into the background of the company itself. So this is where we would say, okay, who owns the company? What's the ownership percentage of each party? Are they an S corporation? Are they a LLC? Are they a sole proprietorship? Who are the primary owners? Who's in management? If you have a CFO or a treasurer or a director of operations or something like that. Do they have an audit committee? Or is there a board of trustees or a board of directors that oversees things? Those charged with governance, related parties, this is a big one. So does the company have, one person owns this company and then they also own 3 other companies? Are there transactions going back and forth between this company and those other related companies? Does this company have investments in other companies? So then are they related, you got related party loans going back and forth, related party sales, and agreements that we have to then disclose in the footnotes of the financial statements. Locations, other, so kind of what we come down to is describe potential financial statement risks. So you're going to see this question like 5 times in this checklist. Because ultimately it's risk. It's risk on our end. What areas do we want to focus on when we do the audit? Based on past experience, if it's a recurring client, based on past experience, do we know, oh yeah, a certain area, we always have to do a special calculation, or oh, remember last year they had trouble calculating this themselves, so we may have to look harder at that, or oh, hey, remember they have a loan now, they didn't have it in the past, so we're going to look harder at that than we would otherwise. They acquired a new company, we're going to have to look at that transaction more than we would have previously. Anything involving more risk. So risk, you'll see risk throughout this checklist. We would talk about, risk related to the industry. So oil and gas, there's always a risk of commodity price going up, going down. There's a risk of regulation based on the current political climate, depending on who's in office, how Congress feels. If gas prices are high, then everyone wants to regulate the industry. If there's a fracking incident or something like that, then there's a risk that, from now on companies aren't going to be allowed to drill or frack or something like that. I'm trying to think of other industries that would have risks. It's like manufacturers, if there's a EPA thing or something like that where they're cited for, a clean air violation or something like that, and they say, going forward, every steel plant has to have a certain thing on it. Well, now if we're auditing a steel company, that's a risk because now their earnings can be affected. Nature of the entity, that's just, do they have certain concentrations? So do they buy all their supplies from one company? Or do they have one customer or 2 customers? So we have some clients that maybe have 4 or 5 customers that make up 80% of their sales. Well, if 2 of those customers go out of business, they're in big trouble. Competitors. If you have a lot of competitors, that's a risk. There's purchasers and suppliers, major assets, liabilities, and expenses. So here's where we would talk about what do they have on their books? Do they have a building? Do they have properties? Do they have, is cash the biggest balance on the balance sheet? Do they have a bank loan? Do they have a huge amount of accounts payable and not a lot of revenue, or just things like that? We would talk about what's on their actual books. Significant transactions, did they do anything out of the ordinary this year they didn't do last year? benefit plans, that's, you know, your 401k. If you have a defined benefit plan, like a pension for a steel company or something like that. Compensation, and some of these kind of get, you know, we kind of just give a boilerplate answer to them, but major sources of financing, that's debt, you know. Derivatives, GAAP, this is a big one. Are we going to do a GAAP financial statement, or are we going to do some other form of accounting? Usually it's income tax basis or cash basis or modified cash.
It's called Octobola.
Yep.
I don't know if you guys talked about that or.
Briefly.
Okay.
Significant accounting policies, revenue recognition, this is actually a real big one going forward. FASB has come out with new revenue recognition policies that are going to be effective, I think, is it 2 years away, something like that?
2019 for
2019.
public and 2020 for private.
So it defines how you recognize your revenue. So there's like certain steps you have to go through and figure out if you're recognizing revenue properly. So that's an
We
accounting
guys
policy.
talked about that in intermediate. Yeah.
Again, a lot of these questions kind of ask the same thing, so try not to get too bogged down in them, but it's all about risk. Again, you know, what are the risks, what are the risks, what are the risks, over and over again. So we would document here, this is the background of the company, here's the risks, here's where we need to focus, which would lead us to the next step is, so this is where we would sit down as an audit team, let's say, and usually it'd be, you know, Franklin and me and maybe somebody underneath me. And we would go through, okay, we've described the risk, we've described we want to take on the client. How do we handle it now? What do we do?
Oh,
Is that you?
that's me. I'm sorry.
Your wife's calling.
My wife?
Some people have no clue.
So here's where we would talk about, we met and these required discussion topics. We don't always, you're supposed to actually discuss each of these topics. We don't always discuss every single one. Believe it or not, yeah. But here are areas you might discuss. Again, significant risk, areas susceptible to management override, meaning, you know, if we have controls in place, but I'm the president of the company, I can go in and do whatever I want, that defeats the purpose of having controls. So we would discuss, hey, keep in mind, he has access to every part of the software. He can create checks and write them. So we need to do a procedure where we would probably recommend you not do that, but we need to do a procedure to test that now because we know that there's a possibility of that happening.
One of the things too, that this changed a couple, gosh, I don't know how many years ago, but there's a new auditing standard that came out that said you have to do planning. Because what would happen, Mr. Mitchell, you remember, you'd go out, you'd be a recurring engagement, you'd go out there, you'd start it, you wouldn't see hide or hair of the partner until the very end. The partner would come out to review it, and the partner would say, oh, well, we didn't do this. And then you go, I didn't know anything about it. You had no idea. Well, part of this standard is to force the partner, the manager, and the audit team to talk before the audit starts, to plan the audit, to say, okay, where are we go through all these questions, and we talk about the risk, and we talk about what we think we need to audit, and then the team, we design the audit programs based on that discussion. So because a lot of times there could be issues that I know about that we've had discussions with the owners or whatever throughout the year that the team doesn't know anything about. So that's why it's important to have this standard. It has to be done before the audit starts, right, Indy?
Yeah, which means sometimes the morning of, we have to meet quickly. Okay, we met, we had a discussion, Do you want to talk about materiality?
Yes.
Okay, because one of the things we would talk about in this meeting is materiality level. So, and I'll pull up the checklist here if I can find it. One of the things that you always talk about in an audit is whether something an item is material or not. So we have a checklist, and I gotta find it, but.
Right there. Put it.
So So we run through this checklist, and usually it's based on either total assets or total revenue down here. So it goes through a formula, and I'm scrolling up and down here, but it goes through a formula based on what you're using as, is it total assets, is it total revenue?
Didn't I give you guys a copy of this in Blackboard, like way back chapter 7 or 8? I think Andy gave me this worksheet a while
I think
ago.
it did.
And I think it's posted in your, one of those earlier chapters,
So
which maybe meant nothing to you then, but.
So let's say they had, you know, $1 million in assets, just as an example. So now, so put the assets in. Our plan materiality is 18,000. So that means there are certain items where we're probably not even gonna look, if there's a variance or there's something's off for a real small amount, we're probably not gonna look at it, because based on this, we're saying anything below 18,000 is immaterial. I mean, there are times where you might look at something that's small if it has an effect on, like the example we always use is if they have a bank covenant, and $18,000 either way could throw them out of their covenant or keep them in their covenant. Well, that could be material. $3,000 could be material at that point. Or if it's the difference between like a profit and a loss. There's a possibility, hey, you have a $2,000 profit. Well, $3,000 makes a difference between $2,000 profit and a $1,000 loss. Or if there's like a bonus calculation and it's based on a certain amount and they're a couple $1,000s away from that bonus calculation. There's a possibility then that becomes material. Usually we don't have that, but it's possible.
And this is the one thing that's different between accounting / bookkeeping, and auditing. Accounting, you have to be exactly right. I mean, you have to balance. Your cash has to tie out to the penny. Your accounts receivable aging needs to tie to your detail exactly. So there's certain things in accounting and bookkeeping that have to be exactly right. With auditing, you look at it kind of from that big picture type of approach. You know, is it reasonably stated? You know, you use the materiality. Do you look at those? You know, say you have a variance in your prepaid expense of, you know, $100, whatever. Well, okay, I don't care. As an auditor, it's still close enough. It's reasonable. You know, so you take that big picture approach on certain things. So that's kind of just a very brief difference between, you know, accounting, bookkeeping, you have to be exact. Auditing, you kind of look at it for reasonableness.
And sometimes it's an efficiency question too, or a question of time. You don't want to spend 3 hours to chase $10. And sometimes clients, you know, we've been out and they want to get it right, so they'll go search for that $10, and it's like, well, you're close enough, it's fine. Just let it go, because we need to keep moving on our end. So we're going to go with it and don't worry anymore about it. But a lot of times they'll come back, you know, an hour later and say, hey, I found that $10. Okay, thanks. But at least they made the effort, and you can kind of tell, okay, they want to get it right, which is a good thing. It's not a bad thing at all. But from a auditing and a time standpoint, you have to kind of remember, okay, I only have a certain window where it gets done, and I'm in the office and you're in the office, so it's close enough and we're fine with it. And you also have to convince them sometimes, like, really let it go, it's fine. Okay, so those are kind of some of the items we would talk about in that planning meeting. You know, again, risk, what are the largest risk areas? Exercise what we call professional skepticism, meaning don't necessarily just take their word for it, make them prove it. I mean, I think the clients that I work on, I think they're all honest. I think that they always have good intentions, but you still can't just completely take their word for things. You still have to say, okay, we're still going to confirm this bank account, or we're still going to need to see invoices for, you say you bought a vehicle this year, okay, I get it, I see it in the parking lot, okay, but give me the invoice for it.
The old adage is Ronald Reagan, trust but verify.
Yeah, so it's just a matter of documenting it and saying, yeah, they say they had this amount, here it is. And they know that too. So they're, most of the time, again, clients are very eager to give you, a lot of times we get too much documentation. They want to give you everything. It's like, okay, well, I don't really need that, but you don't want to say, don't give it to me because then you don't get enough. So it's kind of just, give me everything you have and I'll sort through it. But there's times where, yeah, they want to send you the whole, every piece of paper from the entire year. And then we would, after we discuss and go through some of those areas of risk and what we're going to do, then we decide, okay, this is significant decisions, plan responses. So we're gonna look harder at X, Y, Z than we did last year, or we're gonna focus on cash and receivables, because that's 90% of their assets. Or a lot of times that ends up being, I don't want to say we're going to do the same thing as last year, but we're going to approach it the same. The areas of risk are the same as last year. We're going to approach it the same way. And I know Franklin likes to do different procedures every year to kind of mix things up. So there's a lot of times where we'll throw something in that's we didn't do last year. We might ask for a certain report, or hey, last year you gave us everything over $5,000. This year let's make it $4,000, just because, just so they don't get comfortable and then know, oh, they're not going to ask for that because they don't ever ask for that. So you do try to mix it up a lot of times.
And some of these changes in the standards have come about because of audit failures. Because, like Amy was saying, you have to mix things up. Certain bookkeepers and clients, over the years, they would know exactly what the auditors would look at. They know how they did it, and so they would know how to work the system. And so by changing things up from year to year, you keep them on their toes, so they never know what you're going to ask. And that's what you really want. You want that, that account, person that you're working with at the client to just never really know what you're going to ask. You want to I don't know if this is the time and place to show, but you see, talk about the identified risk on the program, how you can do that. You want to wait till the next?
I was thinking next
one.
I
Okay.
can.
Okay, go ahead.
We're talking about fraud risk inquiries.
Well, you see how it says identified risk off to the right?
Oh,
Yeah,
sure.
yeah.
There's management override patrols, which we kind of talked about, and improper revenue recognition, which we also kind of talked about. As far as these are items that could be like overall risk, not necessarily just one area like cash or receivables. These are like over the entire financial statements. So we always try to have these as identified risk regardless of the company, regardless of the industry, regardless of what area we're auditing, because those are kind of universal.
But then as you're going through these programs, okay, if you come across something and you want to add a risk, okay, show them how you add the risk then off to the.
Come on. Wait a minute, I'm gonna take a picture. Oh, yeah, he's gonna type it in.
Oh, you used it, okay.
Fun.
You want me to add one?
Yeah, just add, say, added risk, fraud risk, yes or no. So-
Remember when we talked about the risks, whether it's overall financial statement or a specific area? Did you see where he just checked that box? Financial statement, overall financial statement,
Yeah, or I could do.
or you could,
cash
yeah.
receivables.
So then it shows up on your, over on the right-hand side, that's where it accumulates all your identified risk.
I don't remember that coolness. That's neat.
I'll never forget that, we were 10 years ago, when Mr. Mitchell had a student that went through Stark State here, and we hired her, and Jonathan came in, and we took him into the room that he remembered as the, file room.
No, I didn't remember it because I wasn't there in
Oh,
that
you
beautiful
weren't that- oh,
office
you
you
weren't
have
that-
now. I was in the
okay.
old office.
Put all this stuff up on the screen, and we were walking him through, and all he'd say is, "That's so cool. That's so cool. That's so
still
cool."
so cool.
And it is. It's really cool. If you remember,
Yeah.
old school, new school, it really is slick.
Yeah. Wow. Makes me want to go back. But I can't leave you all.
So one of the things that we would do either during planning or usually it's more likely that we're gonna do it when we're out doing the field work, is inquire about fraud risk. So this is always kind of weird for me when I'm doing an audit, because it's more or less, we try to talk to somebody in management, we try to talk to an employee, maybe somebody that's like in government, like on the board, let's say, but kind of ask them, okay, are you aware of any fraud? Are you aware of allegations within the company of any fraud? We might get into, if somebody were to commit fraud here, how would they do it? Or we might ask, do you feel that the controls in place are effective and that they follow them? Okay, yeah, you give me a control book and say, these are all our internal controls, but then somebody says, actually, we don't follow any of those. Well, that's kind of an issue, you know, not necessarily fraud, but just, yeah, you need to do a better job of doing that. But it's just kind of weird for me to just flat out ask somebody, hey, you aware of any fraud? Yeah, they usually know it's coming, and usually nobody freaks out about it, but I think sometimes people hear that and they assume that you found fraud. Like, no, I didn't find any, it's cool, really, it's just, I'm checking, I have to ask, but you never know, I guess. I've never had anyone say to me, oh, you know, actually there was an incident where we had this. It could happen, you know. They're not gonna admit about themselves probably, but if they heard about somebody else, they could say, yeah, you know, we fired a guy during the year for stealing. Well, that changes the audit then. We may have to do additional procedures because of that. If we didn't know about it previously, now all of a sudden we may have to go audit that area. Let's say they stole inventory. Well, now we got to audit inventory more, because are we sure that it's reasonably stated? Because somebody overrode controls or somebody stole something from it. We don't know. So that's ultimately why we ask. And frankly, I don't know if you've ever had anybody actually say when you ask them, but I never have.
Yeah, I have. And you know, if Andy's out there, first thing we tell our team to do is, if you come across anything, if you know any client represents or says anything about, call a partner. Just call a partner, and then partner will drop everything. Unless I'm at the beach, and then we'll come and we'll talk and we'll figure out what the deal is. Because you have to tread very carefully as you're going through this, because you don't want to accuse, because you can get into one of those things where you you have a disgruntled person with this person. Well, that person, they're committing fraud, or they're doing this. So you have to be very careful about it.
It's kind of a fine line too, because like especially when you first start, I think talking about like movies and TV, you assume that like, oh my gosh, I'm gonna get in there, dig in and find fraud and criminal activity. But not every misstatement is fraud. It might be a typo. It might be, oh yeah, I forgot. I mean, okay, it could be fraud, but a lot of times it's just, oh no, you gotta add these two together. Oh, okay, now I see it. But I think when you first start, you have this assumption like every mistake you find is like, well, they commit fraud? No, the formula in Excel is wrong. Oh, okay, But at the same time, you can't assume that there's no fraud at all. You have to, it could happen. Like I said, I've never seen it, but it could happen. So you can't dismiss everything either. So it is kind of a fine line, and you don't want to throw that accusation out there unless you're absolutely sure that there's some issue. You can't go like, hey, it looks like somebody stole something. You got to know anything about that. You have to be very careful about what you do and how you handle it. So this is where we would ask, is what I'm getting at. And then we would go through understanding internal control. So this is where we would describe their setup. From a big picture, control environment, kind of like from the top down. Do they demonstrate integrity, ethical values? Do they have board of directors? Is there oversight? So consider the following principles here. That's kind of what we would go through and answer these questions. And then considering the size and complexity of the entity, which is important because not every company, especially the ones we deal with, like small local companies, they're not all going to have an accounting department. It might be a bookkeeper, and that's it. Or they might have 2 people in the accounting department. They don't necessarily have an internal audit department. They don't have a CFO and a treasurer and a controller. They might have 1 accounting person. So you can't say to them, well, you should really have XYZ controls in place. They're going to say, well, that's fine, but tell the owner to hire somebody else, because I can't do all that. I can't sign the checks and well, actually, you know, like I'm creating and signing checks right now. So what you do is you try to mitigate that by saying, okay, at least have 2 people looking at something. At least have that. Don't have one person able to do everything. You know, create a check, sign it, send it out. Or receive the mail and do the bank statement, and, you know, you want to have that separation of duties to the point where it will require collusion to commit fraud. At least 2 people are looking at it. At least you would mitigate it by doing that. And then some companies, they have a whole accounting department and a whole internal audit, you know, of the bigger companies. So again, risk, over and over again. A lot of these questions come back to the same thing. So how do they communicate information? How do they create their financial statements? How do they do their monthly reports? This is where we would ask questions, you know, to get to how they do that. Monitoring. Do they actually have a system? Do they monitor it?
You guys remember these? That was the picture back in chapter maybe 11, I think, where we had the big umbrella with the control environment and the blocks under it. That's what we're going through. These are the pieces, those little blocks that were under the big control environment umbrella. In case you didn't recognize the words.
IT, this is actually kind of a big one, because if your server is out in an open room, or clients don't have, employees don't have like passwords to their computers, well, theoretically, then somebody could come in and commit fraud using QuickBooks or using the company's accounting software. So we would look at that and say, what controls do you have in place over that? You know, do you have a backup? If your server crashes, do you lose all your information? Well, at that point, how can you create financial statements that we can audit if you don't have any information?
Does anybody in this decade say no?
Yeah.
They don't have backups?
Usually, well, they have backups, but it's usually, I did it once a year, and it's,
Oh my
you know,
God.
it depends on.
Really? That's dumb.
Not many, but some.
Not many. Most of them do.
Most of them do.
You get burned once.
Yeah.
You know, it doesn't take you too long to figure out why, but keep those.
And most of them are doing cloud backup now, or off-site
Yeah,
hard
off-site,
backups?
or someone will take it home with them, you know, over the weekend, let's say, the backup. That way it's off-site. Or sometimes we use like a bank deposit box or something like that. And then a lot of clients we have use like third parties to monitor their servers, monitor their IT and their antivirus and all that kind of stuff, because it's hard to do yourself.
No, the safest thing is to have it out on the cloud, and you always have backup.
So these are like the different transaction classes that we would look at then. And we might do a walkthrough and let's say, okay, cash, how do you do your cash when you get it in the door? What do you do? Oh, well, the receptionist opens the mail, and then she passes the bank statement to the controller with a copy to the owner, you know, or then that we receive the checks and blah, 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 blah. So we would walk through that here for each significant class. So at this point, we've done all the kind of planning, all the documentation of the company itself. So then we would go into, kind of along these same lines here, each type of financial statement line item.
Look at that, you guys. This is one of my favorite parts. Keep talking, Andy.
Okay. So is it significant? Cash is usually always significant. Do you plan to test controls in this audit area? We don't do a lot of, because what you can do is, I don't know if you guys talked about this yet, but you can do testing of controls and then reduce what you call your substandard.
Oh, have we talked about that? Have we talked about
Or
that?
have we?
Dear God, they're sick of hearing about it. I said it's a seesaw, or a teeter-totter, right?
Mhm.
The more control tests, the less substandard.
Right.
Now, you think of a big company like Timken, okay, everybody knows Timken in this area. Okay. Their auditors are going to test the controls. They're going to test the controls to make sure that the client has certain controls in place and they're operating effectively. The idea of the controls is, you know, if you have controls in place, they're going to detect or prevent things from happening. And so that you'll have, you know, if their systems and their controls are in place and they work properly, then the idea is that when you get to your number at December 31st, that your cash balance is correct. if you don't have a large client like this, you're going to then do mostly substantive type testing, where at the end of the year, you do your audit testing and you perform a substantive type test, where you send the confirmation, you look at the bank rec, and you do your testing on those balances as of December 31st. So that question, yes or no, determines how you go about your inherent risk and your control risk. So, walking through that, how that works.
While we've turned halfway, let's get Andy on the camera for a minute. Wait a minute. There we go. Andy, wave. This is the man talking behind the camera. Okay. Did you all notice when he... I'm sorry for this video. Did you notice... Did you say no, or was it already?
It was already
on?
no.
Click yes and show him what happens. Look what happens to your control risk when he says... Notice how control risk now is asking you to tell it because you said you are going to test controls. When he said no, control risk was automatically set at high, right? Remember how we said if we're not testing controls, we set control risk at the maximum, what we call low, medium, or high. Because I'm not testing them, I'm not relying on the controls, I'm relying on the substantive testing. This is what I've been trying to describe to you, how this software walks you through this and helps you make all these assessments. Okay, sorry.
Nope, that's what I was gonna say.
We're gonna run out of time, so I need to quit talking.
You got what, half an hour?
We have about half an hour
Okay.
at the most.
So, we'd run through this for each of these items, okay? Normally, on our jobs, we would say, no, we're not gonna test controls. So, it's automatically high. So then these are gonna change based on how we feel, based on the assertion, okay, it might be low. Okay, now see how it makes it the total risk low? I can make this high, no, that's high. I can make it moderate. It could be not relevant, okay? Well then, it's gonna be not relevant. So we go through this whole thing to get, all these across. Then we select an audit approach. It'll allow us to select, it'll suggest basic based on the fact that these are all moderate or low, but if I go high, now see how it changed to extended?
So cool.
So there's additional procedures now that are gonna be part of that audit program because we're saying, okay, well, completeness is high, rights and obligations is high. Overall, it's a high risk, or higher or moderate risk, I guess.
Remember when I told you how it's going to help, that's what he's saying, helps you choose your audit program, it creates the audit program with the extra steps in it for you. It says, now, because you said this, we're going to give you the extended test, the more extensive program, and they're all listed in there for you. Now be sure you do this, 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 and this in addition to the basic.
One thing that's really neat about this program is you go on, you're going through it and getting all ready, and all of a sudden you go, oh, doggone it, what is inherent risk? I forgot. Mr. Mitchell told me about it all the time. You go and you click on there and you go, inherent risk is, there's what inherent risk is. So, gives you that answer. So you don't always have to remember.
Don't. It's a good thing. It's a lot to remember.
So then we run through, okay, for the rest of these, it's the same thing. We're gonna run through the risk for each one. Now this one, accounts receivable, because of the revenue recognition we said was an added risk, or overall risk. See how it breaks it out separately here? It'll still be moderate, but it's gonna show, hey, keep this in mind, you're gonna be high, high. So again, now it's suggesting extended. So we run through all these. Overall financial statements. So, at this point, we've hit each of those items, we've run through the risk, it's ready to, I won't actually generate it, but this program will actually allow us to generate the actual audit program we're going to use and pull it into the audit file. So then we would go over to our audit file. We just got new audit software this year, so we're excited. Yeah, it's
Really?
new, yeah. So if I go over to here, so we're going to pretend like we just generated this out of the software. So now,
Neato.
here's my audit program.
Look at the assertions, go back to the top. On the program, it lists out your assertions right there. And then as you're going down through it, you see on that first step, you see the E/O, the C. That step right there addresses those risks.
So see how I have to spot to sign off then as we're going through the audit program, as you're going to work, you can see where I signed off in last year's class. So here's where we'd sign off, and then there's a part above here where it actually has a little button for us to log in, but so now I signed off on this stuff. So this was all generated by the questions that we answered back in the Smart Practice Aid software.
See how it says basic procedures? That's still in the basic part of it, right?
Yeah, I don't know if this will be extended or not.
I don't know. I don't remember.
So ultimately then, we go through these procedures, and at the end of the audit program, here's where we say, here's, we perform procedures, obtain audit evidence sufficient to provide reasonable assurance, which ties back to the audit report. That's what we're doing, ultimately.
This is only related to cash, because you're not.
Right.
Cash.
Sign off here, and then Franklin would sign off down beneath me there.
That's what's hard, I think, for them to visualize is the practical nuts and bolts. And that's what your audit program gives you every step. We just went over this the other day. It gives you every step you have to do. And you have to have, doesn't your thing, it won't let you file your papers till every step is signed off?
Yeah, it'll tell you which ones aren't signed off. So then, just as an example, that audit program we just did, here's an example of the bank reconciliation. So I would have gotten the bank reconciliation, put it, scanned it in the file, and then I would have